Nice stock is down 35% over the past 5 years. It is down more than 50% since all-time high, more than 54%. Anytime a high quality stock has shaved more than half of its price, I'm getting very interested. And today we're going to be talking about why I bought it, why I own it, and what's my plans with it. So let's get into it. Let's just take a look first. First of all, we always want to take a look at the price action, at the graph. We don't care about the price. We don't care about this number. We just care about the swings, okay? In percentages. It doesn't really matter if it's 300 here or 300,000. I couldn't care less. So it's shaved off more than 54%. Why does this matter? Well, this matters a lot when taking into account other factors because the price has been going down by more than 50%, but valuation might have gone down by more than two-thirds, more than 67%. So I'm going to be talking about that in a moment. But this is an old company. This is a pre-dot-com era. So this is quite an old player. I'm not going to tell you what they do. If you're interested in this company, just go ahead and, I don't know, read Wikipedia, watch videos on YouTube, whatever you may do. This is not the video where you learn what the company is doing, okay? This is not that type of educational video, okay? We only talk here about numbers and stock investment strategy. When to buy, when to sell, why should we buy now, why should we sell later, and stuff like that. We talk a lot about the numbers and percentages and overall investment strategy and philosophy. I'm not going to teach you what each company does in particular. And yeah, there are other channels for that. So we're on stock analysis now. Market cap of this company is a little bit over $9 billion. PE ratio is around 20. Forward PE is 11. And if you take into context that this is in the software as a service segment, yeah, it's already getting very interested. All we need to know now, the next thing I'm interested when I see this kind of big drop and the segment that it's in are a few things. First of all, does it have high margins and does it have high sustainable growth? If price action goes against the company, but if the company is still growing nicely and it has high margins, sustainable margins, or even better, growing margins trending up over time, which means taking market share from competitors, that's even better. So we're going to take a look now. Let's go into financials, income statement, revenue growth. Let's take a look here. Growing nicely. Not exponential growth. It's just going to be high growth across the board. Some years better than others. As you can see here, 2016 going from 1 billion to 1.3 billion and then cooling off for a bit and then picking up again. But yeah, let's take a look in percentages. 6, 9, 31%. And then again, 8%, 4%. So yeah, if you took an average here, I would say the growth rate is a little bit over 11%, I would say, last 10 years. So that's good. Still double digit growth. And exactly what we want to see is that last 4 to 5 years, when the price has been dropping the most, this company has been growing in revenue. So great green flag for us when we're trying to purchase a stock that is falling in price. Top line revenue growth is still there and consistent. We did not want to see some type of very high growth in the beginning and complete slowdown to the point where it's flatlining. So yeah, that's a green flag for me. Net income, let's just take a look at the numbers. Almost $500 million, quarter of a billion 10 years ago, and then 100 million. I don't know what's going on there. We will dig deeper. Shares outstanding, 61 million shares 10 years ago. They were diluting for quite a while, which is a bit of a red flag because as we saw before, this is a very old company, pre-dot-com era. So why do they need to dilute? Could be something to do with stock-based compensation, which again, we have to take a look at the number. So keep in mind, but last 5 years since 2021, they started to buy back shares and reduce share count. And as you can see here, minus 0.6, minus 0.3, and it accelerates, minus 1%, minus 2%. We're going to take a look at the raw numbers invested into share repurchases, but yeah, the percentages are more and more because share prices are cheaper and cheaper, and they have become more profitable, and most likely they have more money to allocate towards share buybacks. So let's take a look at the margins next. 67% last 10 years, 10 years ago, and it's been flatlining basically around that number, 67. Operating margins, growing last several years, so that's good to see. I think we can say that it's a bit on a slight uptrend if we don't take into account this 18% from 2015. If we just take this last period since 2017, we can say it's been gaining some type of market share and had some release of pressure to the margins. So margins have been improving, which is again great green flag for us whenever we are trying to buy a declining stock. So here, 2015, again, it was very high. Most likely something happened where they acquired another company or they have merged with another company, and this has completely skewed their margins. So yeah, keep that in mind. Whenever you see huge drops like these, 28% down to 11, yeah, something is going on there. Not that the company is doing much, much worse than it was 1 year before. Free cash flow margins, again, fairly consistent. I would say average of 25%. Again, good green flag. We have seen only solid green flags so far. Cash and cash equivalents, not all-time high, but pretty close to all-time high. We are sitting on almost $500 million, let's say. And keep in mind, we are talking about a $9 billion market cap. So why does this matter? Well, if they had, let's say, $1 billion in the bank in short-term cash, that would be ready to be deployed into share buybacks, let's say tomorrow. Not all of it, but starting to accelerate buybacks in the next 2 quarters, let's say. That would matter a lot because their market cap is 9 billion and they have around 1 billion of disposable cash. So that you should take that into account. I wouldn't say this is a massive green flag. It is, though, a green flag. Let's just say slightly green flag. Total assets going up over time. Good. Total liabilities also going up over time. No, I was taking a look at current liabilities. This is liabilities going up and flatlining since 2021. This is great. This is gonna mean we are gonna increase in shareholder equity, which is good, but I'm not really interested in this type of stuff unless I'm looking into some kind of industrial type of company which has low margins, high debt. I want to have as high equity as possible, just in case, they risk bankruptcy or anything like that. But this stock is very far from bankruptcy. Let's take a look at total debt. Total debt is nothing. Trailing 12 months is 500 million. Let's say $500 million. It was around $500 million 10 years ago, and they can just pay this off immediately if they wanted to. So yeah, they are net cash positive, all-time high. Again, great. This is a green flag. Great to see. Net income, let's see here. 10 years ago, yeah, something happened here. Some type of merger acquisition because their income dropped, their margins dropped. I'm not sure what's going on there. But net income, we have come again at all-time highs, which is good to see. Now, the next thing we care about is stock-based compensation. So keep in mind 465 million of net income. Whenever you're calculating stock-based compensation, you should calculate it as a percentage of net income and not cash flow. This is my opinion. That's just how I do it, how I like to do it, and also not top line revenue. But you can take a look and calculate as a percentage of all three if you wanted to. But that's gonna be very time consuming, especially when you're looking at 50 different stocks in the segment. So it's gonna take a lot of hours. But you can do it if you wanna get a very clear picture of everything that's going on. So stock-based compensation flatlining since 2021. It's around 181 million compared to 465. That's quite a lot. It's a lot. It's around 40%. I don't like it. So as you can see, before we had the share dilution, that's probably why. Excessive stock-based compensation. I hate stock-based compensation. So this is one of the reasons why I have not allocated a lot of my portfolio to it. I have around 1% to it, which is not a lot, but it mostly has to do with the price and valuation. And we're gonna take a look at valuation next. But yeah, operating cash flow, 863 million. That's nice. Investment in securities, 400 million. That's interesting. What are they buying? Repurchase of common stock. Let's see the raw numbers. How much cash are they deploying? So yeah, they took kind of a break here, 2017, 2018. Probably were low on cash. and then they picked up again with the buybacks. They did 73 million in 2021. Not so, they are probably not so proud of it right now, also from 2020. But yeah, they have done more and more and more since then. Trailing 12 months, $600 million. That matters a lot compared to a market cap of 9 billion. That's a lot, okay? That's like 7% or so. Yeah, that's a lot. So keep that in mind. Great, huge green flag that is gonna put a lot of upside pressure on the stock price. Market cap, let's just take a look by quarterly. We are at 9 billion and 50 million. Let's just say 9 billion. When were we before? 9.1 billion September 2019. So almost 6 years ago, this company was trading, had a market cap of 9 billion. And I mean, you saw the stats. The revenue back then was less than half than it is right now. So around 300, 400 million. Now we have 700 per quarter. That's pretty great. Good. So market cap has been going down by a lot. We are able to purchase this at a significant discount. PE ratio. So why does this happen? It usually happens when the stock goes out of favor. Maybe there are some fears surrounding it. Maybe, yeah, it's just unliked because of some reasons. But the raw numbers, they don't lie. The company has kept on growing, even though it's disliked and unfavored. And this offers a great opportunity to buy something at a very cheap price that is still growing and high quality. The margins are not extremely high for the software as a service industry, but they are still very high. So PE ratio, let's take a look at this. Let's take a look by annual so we can read the chart better. So yeah, 20 for the type of company that it is. It used to be trading in the bubble of 2021. Used to be trading at a 96 PE ratio, which was insane. Everything was in a bubble back then. But now it's 20. Future forward PE is 11. So that's great. I don't see a graph here for forward PE, so maybe on another site. But anyway, price to sales around 3 for a software company. High margins, no debt, no capex. This is ridiculous. Extremely low, very, very low. EV to EBITDA about 10. That's a very sweet spot for me personally to buy companies. EV to EBIT, if you hate EBITDA, it doesn't really matter. We're just comparing numbers here. We're just comparing where it's at today compared to what it was before. So it's at the lowest point in the last 10 years. It doesn't matter if you like EBITDA or EBIT or whatever. You just take a look at the graph and compare it. Compare it to its own history and then compare it to other players in the market, the competitors. What are the other opportunities out there? What is the growth rate of the competitors? Also the valuation. You have to look at everything and compare everything together and make a decision that way. ROIC, return on invested capital, trending up since they had some type of merger acquisition here. I think, yeah, all metrics in 2015 have dropped for a while and then they're on a recovery path, which I like. It's not super high, 8%. Could be better, but it's not a red flag either. It's just, let's just say a white flag for this type of company, software as a service. Being pretty much the same as the S&P 500 average, I would say, yeah, it's okay. I'm not getting it. Yeah, it's just a white flag. It's not a red. Same with return on capital employed, 15%. I would say it's a bit better than the S&P 500 average. So not a green flag, not even slightly green flag, just a white flag. It's okay, no red flag. So it's okay for me. FCF yield, free cash flow yield, used to be at 2.2%. Now it's at 9%. So 3 times cheaper than the market. Actually, a bit more than 3 times. The market now is 2.7 or something like that. That's kind of crazy. We are getting it much, much cheaper, a bit higher quality than the market, and yeah, accelerating buybacks. Why doesn't this matter? Why does accelerating buybacks matter? Well, first of all, it tells us a few things. It tells us that management not only has cash right now, increasing cash piles, which means they have become more and more profitable, and the management is confident about using this cash to buy back shares and not make some type of acquisition or reinvest in their own company to fight off competition. So they just take this cash and return to the shareholders. This shows confidence. This shows that their moat is solid and is going to be solid for the upcoming, I don't know, at least 12 months, 18 months, something like that. I don't want to say 3 to 4 years to 5 years because that's just going to be ridiculous. And this type of software as a service with AI now changing everything. But yeah, they are heavily involved with using AI in their business, so keep that in mind. But what else does it say? It also says that the future prospects about this company are looking good. They are looking to become more and more profitable. And yeah, also it tells us, how should I put it? What did I want to say? Also, it says that when there's accelerating buybacks like that, it says that the management believes that the company is very undervalued. So if they had just maintained the same kind of cash flow into repurchase of common stock, so let's say same type of growth we had here, they would have arrived, I don't know, at some type of 300 million trailing 12 months number. So, but you can clearly see it's almost exponential growth in share repurchases. This is saying, yeah, we believe we are very undervalued right now, and we want to deploy a lot of cash, and we are able to do it. And yeah, this share repurchases are always a great green flag whenever you're trying to buy a declining company, a company that is declining in share price, not necessarily in business metrics, but because as you can see, all of the other metrics are going up over time. So this is exactly the type of situation that we want, getting something at a very cheap price. Buy low and then sell high. When am I going to sell it? Well, considering that this does not pay a dividend, I'm going to be taking profits quicker than it would be. For example, I have this top position of mine, PepsiCo, that pays even now more than 4% dividend. I'm not in a hurry to sell it. Let's just take a look here. PepsiCo, I'm up 14% on it, bought it at a very good price, almost catch the bottom here at 129. I think the bottom was 128 something. But yeah, I'm not in a hurry to take profits. I did not take any profits from it at all. And if we take a look at the price, because it's paying me more than 4% in dividends, actually a little bit less now. But as you can see, the price has been moving vertically. And you could say, oh, you can take a little bit off the table right now. No, I'm just gonna ride this until it almost fully recovers. I'm just gonna keep it for a couple of years. My dividend yield on cost is around 4.4%. So I'm just gonna get, for the money I invested, I'm just gonna get 4.4 in the next 12 months, another 4.4, another 4.4 in the next 3 years. So that's 13.2. That's great, just to hold it and make some type of recovery. Let's see. 130. I'm looking for 130 since when I bought it. Gonna be making almost 50% in share price appreciation, and then add another 13 on top of it. But yeah, if this goes up vertically, I'm definitely looking to reduce my exposure to it. It's very close to the bottom where it got rejected in February 2025 here, 139. So 143. I might add a little bit more. It seems like it's trying to find the bottom here. It violently rejected 152 in October 2023, and it went up on a heater of 70%. If it goes on this type of heater, 6 months, 70% up, I'm definitely looking to maybe exit almost completely and find some other opportunity. But if not, if it's slowly climbing, then I'll just take profits as it goes. But yeah, it depends how fast it's gonna go up. I'm gonna be making videos updating on every single stock that I buy and sell. I'm gonna be making monthly updates of what I bought and sold. So yeah, gonna update you guys.